Thank you for joining us today. My name is Matt Fox, and I'm the CEO of SpotGamma. Today's discussion is led by our founder, Brent Kochuba, as we show you how volatility is moving today's markets and shaping your trading returns. Very quick pause of disclaimer slide so everybody saw this is not trading advice. Thanks, Brent. So first, before we dive in, if you're new to SpotGamma, Brent founded SpotGamma in 2020 to unveil how the options market drives prices across stocks, futures, and even the largest US indices. Over the past 5 years, we provided our insights to international publications such as the Wall Street Journal, Bloomberg, and Reuters. We've contributed to key academic white papers with Columbia University, advised global governmental agencies around the risks associated with options trading, and most importantly, delivered knowledge and proprietary content to our trading community. And now let's turn our attention to volatility. This is very smooth. Whenever I pause, Brent moves it forward. All right, today's talk. So getting into it. In today's discussion, we'll break down how traders define volatility, price volatility, and even more importantly, we'll show recent examples of how to trade volatility and apply specific metrics to improve your returns. So I will now hand it over to Brent for the core of today's discussion.
Cool, thanks, Matt. Hey, everybody. Again, it's awesome to see a lot of familiar faces and then some new people here as well. And so the goal here, as Matt just mentioned, is we're going to dig into what volatility is, some of the signals that you can get out of volatility, and hopefully kind of whet your beak to join us with some future webinars that we have coming up on the topic. We generally here at SpotGamma feel like this topic, that is volatility, is a little sort of underserved. And so a lot of what we're doing now is trying to better serve that specific topic, offer better data and tools and things like that. And so we will now move on ahead. So before we start, I wanted to put this little self-assessment together. I look at, dozens of different trading tools out there. I've seen them all in my, I hate to say 20-year career now, but that's the truth. I'm just getting old. And so I've seen a lot of things, and it led me to this general idea. I think every day we sit down as traders and we see things and we don't kind of like question what they're telling us or what we're supposed to be taking away from it. So our question for you guys before we start is we want you to just sort of think about this ideas or what we're about to say here. So how do you know how to interpret volatility and its expected impact? Every day we hear, oh, the VIX is at 14, or in this case, we have Nvidia implied vol is 62%. So if you were to look that up right now online and see, hey, Nvidia has an implied volatility of 62% as we head into earnings next week, what does that actually mean to you, right? That's what my question is for y'all here. Think about that. 62%, what are you going to do with that number? What could you do with that information? So how do you determine if volatility is cheap or expensive? Let's first consider what drives volatility and ultimately both options and stock prices therein. Now, there are a couple of different categories of volatility drivers. The first being human perception in the form of expectations, right? We had the CPI today, so were people expecting high volatility into that or low volatility? FOMC's coming up or earnings or whatever it may be. And that changes people's perceptions of how market volatility is going to shift. Then the second one is demand for options. And so we're going to be covering all these in depth, but demand for options. So the more people buy or sell of different options, that changes the implied volatility of options. And then lastly, but certainly not least, is realized or historical volatility. In other words, how much has the market been moving? That is oftentimes a great baseline for understanding what the market or a given stock is going to do in the future. So before we get into the rest of our presentation here on volatility, we wanted to make sure that everybody's on the same page with what specifically implied volatility is. That is, what is the definition? Now, I'm not going to bother reading this entire slide off to you. We wanted to make this sort of a clickable moment, so to speak.
Oh, Brent,
excuse me, pardon me there.
You can take a picture of the slide if you want.
Yeah, you can take a picture of the slide.
We'll be sharing this in a recording as well afterwards.
Yep, and if I mute for a second, I'm touched under the weather in case you couldn't tell. So rather than cough at y'all, I'm muting, so apologies for that. Anyways, moving along. The takeaway here from this definition of implied volatility is that volatility or implied volatility is how much movement traders are expecting in the future, and it's almost always quoted on an annualized basis. So even if you're trading an option that expires in 1 month, when you see implied volatility for that 1 month option is say 30%, that's an annualized estimation. So based on the volatility that this option is pricing over the next year, the market expects that that given stock will move within a range of 30% around its current price. Now, the reason that all implied volatility is generally quoted on an annualized basis is for standardization, for one reason. So I can compare what implied volatility is for Tesla versus Nvidia versus the S&P, or even if I wanted to go over and compare it to gold or Bitcoin or whatever else. That standardization is very helpful. It also simplifies some of the formulas that we're going to be talking about in terms of how volatility is calculated. So now that we've touched on that and we're all on the same page, we'll click forward here. Apologies for that. And we're going to start with talking about realized volatility. So many of you have heard the term, let's say, realized volatility or historical volatility. Those are talking about the same thing. And basically what realized volatility is informing us is, given the amount of movement that a stock has actually had over the past, say, 1 month or 5 days or 2 months, how much volatility do we expect in the future? And a great barometer or gauge for future volatility is what has been happening in the market. We all know that there's this idea that volatility is kind of mean reverting. And so when you look at, a huge spike like in the COVID crash of 2020, you knew volatility was going to come back down, but how far should it come down, right? Today's volatility generally, today aside, but the current environment is a pretty low volatility environment, right? And why is that? Well, if we've been having a 9 or 10% annualized realized volatility, then I should expect that generally speaking is what I'm going to look for in the days ahead. And not only that, you'd have to understand that realized volatility for like a crypto stock like a Coinbase or ARM, a semi stock, is going to be different from the realized volatility of, say, Coca-Cola or even the Spiders or S&P 500. So when we use this realized or historical volatility, it's our baseline expectation for what to expect as we look forward. Now, the other thing that you have to adjust on top of this is what events are coming up that this kind of basic realized volatility calculation couldn't forecast or couldn't understand. So we have this measurement. Generally, we talk about 1 month realized volatility is what we're looking at. And so right now it's 10, 11%, somewhere in that neighborhood. What do we do with that information? We're going to be talking about that here shortly. Now, as I just mentioned, the thing that realized volatility or historical volatility is not capturing are events that are going to come forward in the future. So shown here is the term structure for Amazon as it headed into earnings last week. Term structure shows us the at-the-money implied volatility for each expiration date out in time. So as you can see here, there was a real high level of implied volatility in this red box, and that was, of course, due to earnings, as you could see on our chart here. This was the expiration that captured those earnings, and that obviously had implied volatility really rather elevated. Now, the thing that you may know about this or may recognize is there's this shaded cone, and you say, well, okay, I see that there's this very high implied volatility level into earnings. That kind of makes sense, but how do I put that into context? Is this actually a high implied volatility, or is this just a little bit of noise? Now, this shaded cone shows us that the 10th percentile to the 90th percentile of implied volatility over the last 60 days. So you can see in this case that indeed, not only is there this backwardation or an extremely elevated short-term volatility due to Amazon earnings, you can see that implied volatility overall is really rather high compared to the last, say, 60 days. And so that is a critical piece of information that you can draw upon as a trader to understand that, okay, it's this event. Now, in this case, we're looking at obviously Amazon and its earnings, but you could also see the same thing looking at FOMCs or like the CPI print or something like that today. So again, you take the realized volatility and then you project, okay, there are these events coming up. Are those likely to cause volatility or not? And if so, what is a fair price for those? Another big driver of volatility is supply and demand. And I think this is one that is particularly interesting. Just like with most other things, high demand tends to drive prices up, and I think options are no different. The unique thing here is, though, that market makers are required by exchanges to post bids and offers. They have to be active participants in the markets that they are making markets in. As part of their kind of contract or their special kind of incentives from the exchanges. And so, if you think about, hey, there's not very many houses for sale in my neighborhood and prices are already screaming. I don't have to put my house up for sale if I don't want to. But if you forced me to put my house up for sale, what would I do if I really didn't want to sell it? Well, I would charge you some price that if you did decide to buy my house, I would take it. So, if I could sell my house for $100 million tomorrow, believe me, it's not worth that much. But if you want to pay it, great, I'll move. No, you got me. And it's a similar thing with the options market. We saw so many huge moves over the last month, right? Like that ARM stock I mentioned, it was up 20, 40% over a couple of different sessions. Back-to-back moves. Nvidia's up 40% this month. The SMHs are up 17% this year. So, these stocks are really, really moving and call volumes are spiking. So what do the market makers do? They have really just two choices. Number one, they immediately reduce their size, which is a function of reducing liquidity a little bit. So what does that mean? Well, normally, let's say I'm going to post a market that's 10 contracts bid at 10 contracts offered, and it's a nickel wide. So what I'm going to do then, because I still have to post, is I'm going to widen that out, right? So now instead of having a nickel wide market, I'll have a 10, 20, 30 cent wide market. And rather than offering or bidding for 10 lot contracts, maybe I'll just bid or offer for 2. Now, the linked function to that is that they're also, through that, charging a higher price for those options. So if you wanted to buy a call option, then once the market maker decided to widen his market out, you're going to pay more for that option. And that has an effect of raising the implied volatility for the option because the cost is going up. It means that the estimated move that you need to get that option to pay off is also increasing. So what does that do also when they charge a higher price? Number one, it improves their margins, right? They're collecting more money on the trade. When they trade, they're collecting more spread. It pads their P&L a little bit, right? It gives them a little bit more room. The other thing that does is it incentivizes, in the case of a really aggressive call buying market like we have now, it incentivizes long holders to sell, right? If I have a call option for Nvidia and suddenly that call implied vol triples in a day, I'm probably going to want to sell that call because it's so advantageous. Same thing to the put side. If the market's crashing and the VIX goes to 100, if I am going to buy your put back from you, Brent, the one that you own, and I'm willing to pay you again, like my house, $100 million for my house. Okay, you can have my put. I'm happy to roll out of that. So when you start to increase call selling or put selling into those major market moves, it starts to reduce the exposure, right, of the market makers and the dealers, and that helps to ease some of the pressure. And it also invites shorting. Right? Maybe Matt decided he didn't want to buy any Nvidia calls, so he missed the long move, but now he knows that implied vol is 400%, so it might be a good time to sell those call options or short them. And so those two functions, when you have selling or shorting, it helps to relieve some of that upside pressure, right? Some of that hedging pressure, and that can have a big impact on volatility. Now, a lot of us probably understand that there's these options models like Black-Scholes, and that's how volatility in the various Greeks are priced. And that's how these Greeks are calculated. A lot of you may not have looked under the hood before, and there's some interesting points that we want to make. But first, I just want to start with this little anecdote because I think it's really fascinating. And for me, it kind of frames the way that trading really works and the way that markets work. Now, it's Black-Scholes that most of you are probably familiar with. There's a few other models that are out there. But these guys on your screen, Fisher Black, Myron Scholes, Robert Merton, they are the fathers of modern options pricing. And they developed the Black-Scholes model, its framework, essentially about 50 years ago. And it really has formed the basis for options pricing globally. This model or this calculation that they created really allowed traders to standardize options prices so that they could sort of speak the same language, right? We could trade on the same terms. And this is what ties into the idea of implied volatility and making sure that we're speaking, the same language. Now, what's so fascinating about this is that obviously these guys were tied with a lot of success, but many of you may not know that they were actually, specifically Fisher Black and Myron Scholes, they were part of the long-term capital management hedge fund that up until recently was one of the most successful hedge funds, and then also the biggest hedge fund collapse or one of the biggest of all time. Now, the dollars and figures that they lost back then, I think it was several $100 million. It pales in comparison to the billions that swings around these days. But this was one of the biggest blowups at the time, and really threatened the whole financial system. So these guys were kind of academic advisors to that fund, long-term capital management. It's a fascinating story, but I just thought it was interesting that you can have these guys that understand pricing and risk and all of these things, and yet here they are with this firm or fund that couldn't kind of keep it together. It's a fascinating little tidbit. So when we're talking about pricing volatility, how does this actually work? I drew up this diagram that shows a rough idea, or gives you kind of the black box view, so to speak, of how options are priced. Now, into a model like Black-Scholes, or some of you may have heard of other similar models, you have some known and observable data points. For example, what is the stock price? What's the strike price of the option you want to trade? How much time to expiration? What's the risk-free rate? Is it a put or a call? Those are elements that we all agree on, right? They're hard truths, really. Now, you may forecast that the stock price is going to change over time, but right now we got to agree. The truth is that S&P is trading at 49.50, right? The only part of the equation that can differ, is volatility. And so into this model, you put these 5 truths into the model and your estimate for volatility, and out of Black-Scholes, or the jump diffusion model, or whatever it is you may be using, outspits an options price. And what's interesting about this is that when you're a dealer or a market maker, it is volatility that is the input that you are working with, not the options price. And so from the dealer perspective, the lever that they're adjusting is volatility expectations. They're adjusting, increasing or decreasing that implied volatility, and then out of their model spits this options price that shows up on your E-Trade system or your Thinkorswim or whatever it is that you may use. And so when you think about volatility in that same respect, when you adjust this volatility lever, also coming out of this model are all the Greeks, deltas and gammas and all those different things, as well as the options price. And so it is that volatility lever that is really having an immense amount of control on the way that things are priced. Now, what this differs from is our view as buy-side traders or retail traders. When we tend to think about the options market, we see all these same universal truths, but we're looking generally at the bidder offer, right? If you bring up your options montage on Interactive Brokers or whatever, you look at the bidder offer, and then kind of off to the side is the implied vol, right? That tends to mean a little bit less than us. And this is what I think is such an interesting and maybe underserved part of a lot of work that goes out there in terms of options analysis, is that when you are trading an option, you are in some ways making an explicit statement that the market is mispricing volatility, right? If I buy a call, I think that the stock is going to go up more than the market expects, and so that call will make money. If I pay too much for that call, the stock will still go up and I won't make money, right? So that's a volatility estimation. Same thing if I sell the option. I think that the market's going to move less than generally other market participants think. And it's not a dollar perspective, it's a volatility perspective. And that's really what kind of the difference is here. You are trading volatility even if you think you're buying an option for $1 or 50 cents. So when you think about next time you trade, if you start to watch these implied vols, you can start to get some more, I think, better information on a relative basis of how rich or expensive the the option that you're trading is, right? If the call is $1 and you're trading Tesla, that means a different thing from if the call is $1 and you're trading something that has a much lower price, like AMC, which I think is a $6 stock, right? Now, if you look at the implied vols, that's giving you the apples to apples comparison of what the vol is for Tesla versus AMC. It translates the dollar figure to something that works across different instruments. Now, if you look in the hood, open up that hood of Black-Scholes and you look inside, there's a couple of different assumptions. And the one that we're really going to focus on here is this idea of S&P 500 returns. Now, the Black-Scholes assumption is that stock prices are log normal or have what some like to say is a normal distribution. So a normal distribution, for those of you, I'm sure most of you are aware of this, it looks like a bell-shaped curve. And you can see that here in the blue, right? This is actually a screenshot from the SIBO Skew Index white paper. And so you can see this purple line here. It's a bell-shaped curve, right? And when you look at the logic inside of Black-Scholes, you find that they are basically using something like that assumption for the return of stock prices, of underlying stock prices. So again, Black-Scholes assumes that prices are normally distributed, technically log normally distributed. And so the problem with that is that we all know that the market has large jumps. There's right tails and there are left tails. Like today, for example, downside moved a little bit more than people were expecting. The market was pricing 65 bips today. We got more. There's a little bit of a tail there, right? Famously, kind of the difference in options prices, or the change in options prices, was during the 1987 stock market crash, right? The models had never anticipated you could have that much stock market movement. So why does that matter to us? Well, the reality is, and as traders, we all understand that tails are real. Tails exist. And not only are there left tails where the market could crash, but there's also right tails, as we've just seen, where, hey, stocks are crashing up. If you have stock going up 20% a day, that's a crash, right? It's just crashing up. And so what do you do about this, right? As an options trader, how do you address this? How do you adjust the model for this? Well, for that, we present this idea of skew. Now, many of you have seen skew. It's been a very common term. We've been putting out a lot of tweets and videos and all sorts of stuff over the last couple of days here, talking about the elevated call skews we're seeing. But what specifically is that? So if you need to consider that the market could have one of these tail moves, you need to adjust your expectations when you are trading options. In other words, you need to increase your put price or increase your price of your call to adjust for the fact that you could have a really large tail. And so what you're looking at here are actually screenshots from the SpotGamma Skew dashboard. And what you can see is that in general, out of the money options, so this is the spiders on the left, we have AMD on the right. And generally, when you're looking at something like the major ETFs like the Qs or the S&P, you see that put options tend to have higher implied volatility. So this area where I'm highlighting with my mouse, then what we'd say the at the money, or strikes around where the stock is trading, or even relative calls. And that's because, again, after that 1987 stock market crash, people started to buy puts as protection. So there's that demand element, but also the S&P tends to have initial jumps down that are much larger than similar moves up. And so the skew here is essentially the options market making the adjustment for the fact that Black-Scholes assumes this normal price distribution. Now, this works both ways. On the right here, we have AMD skew. This was just a couple of days ago into their earnings report. And you can see that instead of there being this put skew, in other words, put prices have higher implied vols, we have a call skew where people are so excited about AI and the rapid rise of these stocks that they are bidding up the call options, and call options have higher implied vols. And not only that, you can see in the case of AMD, the call implied vol, which is this gray line, is way above the historical range, which is this shaded area. So you know, if you're looking at this, hey, not only is there this call skew due to excess call demand, but this is above what we would normally see. So again, what skew is doing is it's adjusting for that assumption of a normal distribution in stocks. So that covers skew and a couple of the basics around what implied volatility is. Let's look at how this actually can impact the stocks that we're trading every single day. And so what I did here was I just pulled skew readings from recent earnings events to show you how stocks react based on implied vols. Now, for some of you who may not be aware of this, we have this page on our site. If you're a SpotGamma subscriber, you've seen this before, but there's actually a version of it that's for free at spotgamma.com. I think Matt's actually going to post that link in the chat. But you can go and you can see what the earnings dates are, and then you can see an option implied move for every given stock. And so in this case, we have Nvidia coming up next week, 221. It has an estimated implied move. This was a couple of days ago of 9%. And so, okay, that's some fairly useful information. You can see how it prices to relative other stocks, right? But again, what are you going to specifically do with that information? This kind of ties a little bit back to like our opening question is, if I told you Nvidia 1 month implied volatility is 62%, what should you do with that? So, okay, great. We have some basic information. We know earnings are coming up. Move seems a little bit elevated, but what do we actually do with that? How do we actually dig into this? So for that, we're going to look at skew and a couple of other dynamics to interpret what we think may happen. Okay, so in this screenshot here, or graph that we have here, we have a couple of different skew lines, or the same, I should say, the same expiration date over a couple of different days. So in gray was the 1 month option, specifically 36 days to expiration before earnings. So what do you see about this? It's a fairly, what we would say is there's a little bit of a tilt towards puts here. And I drew this red line just to kind of give you this, to infer this. You can see the at the money is right here, and puts have a higher implied vol and calls have a lower implied vol. The whole surface, so to speak, is elevated, meaning that the gray line is fairly high up here because implied vol is high because of earnings. But there's not much of a bullish expectation from traders going into this event if you compare this to the AMD chart we were just looking at. And so what happens after earnings comes out? Well, you have in yellow is the post earnings report, and then there was another follow up with green. So these essentially, the green and yellow lines are what happens to earnings when the stock, or what happens to implied vol, when earnings comes out. And what you can see here is implied volatility overall drops sharply, but suddenly this call skew appears. Now, for those of you who obviously, most of you probably know this already, that Meta had an incredible 15% move after its earnings report. So the market writ large was not looking for that type of mood. Yes, the market was pricing in volatility or higher volatility than normal, but there was not this tilt towards calls. And as a result, you saw a really rather large 15%. Now, they had a great earnings report, but there was a real expression of upside movement after that report took place. Now, I want to compare that to Eli Lilly in its recent earnings report, where you can see there's a mild call skew, I would say, before earnings, which is the yellow line here. Here's the at the money right there. Out of the money calls 5% up. They're a little bit bid. So this is, I would say, warmly bullish expectations, right? It's not that AMD chart, but what happens after earnings there? Again, volatility collapses, right? Comes down significantly, but you see that call skew didn't really come into the stock, right? The call skew, if anything, it flattened out ever so slightly. You kind of look at this and say, it's all pretty average. And what's interesting about this is that they had decent earnings, and the stock was up about 2.5%. So, okay, decent move, not anything, it's not the 15% that we saw out of Meta. Decent reaction. Options traders probably at large who shorted volatility, probably did okay. Now, we showed AMD before, and what you see here is what we call a rich call skew. Now you can see the degree of slope on this red line, which tells us that out of the money calls have a much higher implied volatility than at the money calls. This is the semi-stock, AI stock mania. And you can see before earnings, everyone's extremely bulled up here, right? And I say they're bulled up because the price of calls, the implied volatility price of calls is much over that of at the money calls. And so traders have very bullish expectations. Implied volatility is really lifted. And after earnings, this case, what you can see is not only obviously does vol come down, the green line is after earnings report, but that skew starts to really come out, right? If we were to draw a red line down here, you would see that really flatten out. Now, what's so interesting about this is if you look at the stock performance, its earnings were okay. They weren't dismal, but what you can see is right here, the stock was down 3% in this case. And we would posit that the reason the stock is down is because when you have a situation like this where the expectations, the bullish expectations are so high, it gets hard, or it's a challenge for the stock to overcome those bullish expectations. If you go back to that analogy of the house, if I'm trying to sell my house for $100 million and someone comes along and offers me $50 million, I'm going to be pretty upset about that, right? Because my expectations were I was going to sell the house for $100 million. $50 million is still an awesome amount of money. Like, I don't have anything to worry about for the rest of my life, right? But I'm disappointed. And it's the same thing here. I have incredibly bullish expectations. And so when the earnings report comes out and it's okay, wasn't enough, right? And so the other part of this feature, if you think back to the supply and demand side of things, is that almost always vol comes down after earnings reports. ARM very recently is one of the few times I saw where after earnings, vol goes up. So in this case, not only do you have this issue of the call skew, but after earnings report, vol tends to come down. That means call values are going to come down, and that starts to impact the stock. So when you look at these skews into earnings, there's a lot of information embedded in there, and hopefully this helps to describe a little bit of some of the things you can look at. Now, I wanted to close with this idea for next week. For those of you who have been reading our subscriber notes, we've been, again, talking about these heavy call skews. We've been really fixed on Nvidia. Nvidia is now the third largest stock in the S&P 500. It is the leader of the kind of AI semi-stock revolution here. Stock's up 40% this year. We're only 6 weeks, not even, into 2024. And they're going to release earnings next week, which is 2/21. Now, this is one of the more wild call skews I've seen, and you can see here that there are incredibly bullish expectations. These are 1 month options, and this was taken from just a few days ago. So you can see that there's a very large call skew here. There's extremely bullish expectations. If you compare the current reading to, or yesterday's reading, I should say, market's down a little bit today. But if you compare this reading to where implied vol has been over the last 60 days, remember, the stock's up 60%, or excuse me, 40% this year. It's had a great run. It's been very bullish, but now the estimates are even higher, right? They're even more ramped up. And so this is a very high bar for Nvidia to cross. Now, that's not to say what the actual numbers are that they're going to report. Obviously, we're talking about how the stock will react to whatever the numbers are that they report. And so with that, we wanted to turn back to the original self-assessment question, and we could say factually, again, if you were to look up and find that Nvidia implied vol is 60%, what would you actually do with that? And our answer to you is actually, you can't do much with that 60% at all. A little bit of a trick question. And the answer is because you don't know whether that 60% is high or low for that given instrument. You don't know whether there's a call skew or a put skew or where implied volatility, again, should be after an event or into and around an event. Now, in this case, if you look at this lighter green line, you can see, okay, this is term structure for Nvidia. This is where the at the money implied vols are right now. But where should they be? What's an estimate of what I can assume where vol should go after the earnings report? And you can see this light dashed green line shows us that vol should be around 45%. So now you can make a better judgment already saying, oh, it's at 60. Vol should be roughly around 45% as we move back into this cone. Now I have a little bit better information. I can suddenly increase or improve a possible trade that I would set up. Further, if I say, look, this has one of the sharpest call skews we've seen in a while, and you can see factually, objectively, calls have an extremely elevated price. Now suddenly you're armed with even more information to say, okay, I got it. Implied vols are very high. There's a very heavy call skew. And now I can look at structuring trades that take advantage of those higher prices, those higher implied vol prices. So we don't want you to take this as financial or trading information. Please don't go sell naked calls in Nvidia based on this information, but you can understand how you can use these different skew metrics, term structure metrics, put into the proper context to take, we think, much more intelligent action in the market. So with that, I'm going to turn this over to you, Matt, so you can wrap things up.
Okay, thanks, Brent. And for those of you that know Brent, he just powered through being pretty sick. So thanks everybody for being with us today. It's meaningful for us to be with you. So now that you've got an exploratory review of volatility's impact on the current markets, I want to extend a special invitation to join us for a comprehensive deep dive into the world of volatility, which we're going to be delivering to you March 5th to March 8th. Over 4 extensive days, we're going to walk you through an in-depth exploration of how volatility can be tracked, assessed, and traded. We're going to base this with case studies. There were great questions in the Q&A. You can see butterfly spreads, other ways you can apply this. People have been raising their hands. We mentioned this is not a Q&A session. We're going to be doing some of these webinars leading up to this big volatility challenge week. But our engineering team has spent over a year building this volatility dashboard. Brent showed a few of those tools, showing skew, showing term structure, and we're going to have a lot of those incorporated into the learnings. But this education is for anybody trading stocks, options, or futures and really explaining how volatility works. We're also going to bring in globally recognized academic and hedge fund leaders to give speeches and give discussions with Brent, and there'll be lots of opportunity for breakout Q&A. So to describe that a little more in detail, Brent, on the next slide, please. Back one. There we go. So to assess, we're going to have more than 6 hours of recorded material during the week. At the VIP and platinum levels, you'll get access to a smaller group setting. So before each day of content, Tuesday to Friday, Brent will be in a small room for a breakout session where you can ask questions and interact more directly before the content's delivered. Then at the platinum level, for the following entire week, people that asked about different types of iron condors or spreads in the Q&A, we'll go through those live. You can pull up Nvidia, see what's happening, look at our dashboard, look at our tools, look at earnings calendars, and make sure you're getting all you can out of understanding what does volatility trading really entail. So those seats are available now. You can go to volatilitychallenge.com, but the direct link I'm putting in the chat right now, which I was supposed to do 3 minutes ago, but I'm not built for this. There we go. More of a behind the scenes guy. So thank you guys for all being with us. We appreciate being part of the SpotGamma community. We will be doing more webinars like this over the next couple of weeks where we get deeper into concepts around things like VANA, things like the volatility index. So those are all continuing to be these free sessions, but that week we're bringing in experts, we're putting in more than 6 hours recorded material. You get access to all of that at just the general level. But for additional breakout sessions, then the full week trading experience and feedback live the following week, March 11th onward, we're going to be doing a series of 5 different days of 1-hour sessions of trading experience. So thank you for being with us. Will be more from us soon. Also, this recording will be available probably by tonight, certainly by tomorrow morning, so you can watch this if you have any additional questions. Saw a lot of familiar faces today, so thanks everybody. And we really think this is going to deliver a lot of content and additional edge. So appreciate being with us. And we'll see you soon.